Good afternoon. My name's Lisa, and I get the honor and privilege of being the moderator for the most exciting part of the day. Our friend David Kotok says that when there are two economists in a room, you are sure to have three opinions. As I look around this room, I wonder how many opinions are actually here.
7.
I'm thinking a lot. Ramiro has just asked me if I would have each of our presenters give a brief summary of their economic outlook, and then we'll go straight to questions that we have prepared, and then we'll go to your questions, which I'm sure will be more interesting than mine. I have Professor Dhawan from Georgia State University, Ms. Constance Hunter from KPMG, she's the chief economist there, and Professor Siaba, I hope I'm saying it right?
Yeah.
Yes, who you all probably already know. So shall we work from left to right?
Oh, okay. Let me see. So Lisa started by asking how many opinions this panel will have about the economy, and I think I quipped at that point at least 7. But being in the forecasting business, I may have a lot of opinions about the economy, a lot of different outcomes, and they have different probabilities. But when we present it, the idea is to only give one, which is what I call the base case, the most likelihood outcome. So in my base case, and you heard from Dave this morning, US economy 2.5 to 7, mine is 3.1 till like a few days ago, then came in some data revisions, and keeping the forecast the same, it becomes 2.9. So somewhere in that range, so this year. And next year, we can do 2.5. There's some stimulus coming in. If we don't have any budget problems, like we don't shut down or something, we will spend a lot more money on the fiscal side. And the Fed's job, I say this is a very decisive year in the sense that they will have to move to raise the rates. But how many? Wall Street thinks 4. They get scared when they see any inflation number that goes from 1.9 to 1.92. They get scared. Over here, it's a rounding error. So my forecast is 3 hikes. This March one is pretty much there. There hasn't been any market turmoil as of in the last 10 days that badly. But if the market doesn't go sideways, when I can't forecast the market, if I could forecast the market, I would not be sitting on this dais, I'll be in my private plane. So we'll do one in March, one in June, take a break, come back in December. Life goes along, things pick up. We have an economy that can probably grow at 3% for a short while, but not forever. It's the way I say it. The engine of this economy, when you run a racing car on a track, it has to have a certain engine. It's on the old, what we have done in the investment and the technology in the last 10 years. Now we've gotten a tax cut. Yeah, we can probably afford more gasoline and run much faster, but the engine is still the same. And it's going to get overheated, can even blow up. So that's the caveat. And I believe the investment will pick up, which means retinkering of the engine. It might be a little bit more than what I'm thinking, but I doubt it. So it's safe to assume this year 3, next year 2.5. After that, I think it's too far away to talk about it. That's my forecast. Thank you.
So thank you, Rajeev. We're going to add another opinion, although I think we're at the risk of having vigorous agreement. So what I've been saying about the US economy is that it's like a snowflake, right? It's beautiful and perfect. We have low inflation. We have low unemployment. We have relatively steady growth. We have low interest rates. We have global tailwinds from global growth. We have equity market returns that until recently have been fairly high and created to a wealth effect on the household level. And we have corporate profits that are, in most cases, near or above 10%, right? Beautiful, perfect. But like any snowflake, it's not a state of equilibrium, right? It's not going to last very long. And so how much longer we have this perfect economy is really the big question. And as we heard Dave Altig talk about earlier this morning, there is the chance that we're starting to see rising inflation. If you do the 6-month annualized growth rate, you're seeing a pickup across a variety of inflation measures that have, for the past 5 to 10 years, been very, very tame. Globally, this is the first time since 2007 that we have the global economy expanding almost everywhere. Now, we all know what happened the year after 2007. Right? It was the year 2008. And 2008 brought with it a lot of, brought with it the global financial crisis. And of course, I'm not forecasting a global financial crisis. I'm just saying that when you have growth synchronized around the world like this, you have a greater probability that you're going to run into capacity constraints. And so if we look at Europe, there aren't so many capacity constraints. If we look, for example, at China, there's a large amount of question marks about the pace that non-financial corporate debt has risen over the past 5 years. There's a really great IMF paper actually from January, which looks in detail into this. And if you're interested in this subject, I highly recommend that you read the paper. But it points out all the ways that this could be risky for the Chinese economy. It thinks about the spillover effects, what the transmission mechanism is through the banking system. Chinese banks are highly leveraged. And to the tune of about 260% of GDP. So really a significant leverage situation that if you were looking for risks for the global economy, I would look there. Now, it could be a case of Japan, when everybody was forecasting that Japan's government debt situation would be the cause of a financial crisis, and to date, it has not been. But it's still something that I think bears watching. And then with the United States, of course, there is not just our growth, but our political situation. So the question to me is, did this budget reconciliation bill that was $300 billion spread out over 2 years, probably spent on the back end of those 2 years, how much pressure does that put on the economy? And as Rajeev says, does the car overheat because we're still driving it with the same engine? I'm in the camp of 4 Fed rate hikes this year. I think that's entirely possible. And I think that the risk for the spending, the fiscal stimulus spending, is that it may goose up growth rate in the near term, but over the course of a cycle or over the course of a medium term, 3 years or so, all that would happen if it causes higher inflation is that we would see greater Fed rate hikes, and it would mute the effect of that fiscal stimulus. And then finally, on the topic of when do we go into a recession, which is, I think, really the thing on everyone's mind. I'm thinking sometime in late 2019, and that we'll have a mild business cycle recession. As Doug was saying earlier, because of the impact of the millennials that are turning 25 to 34, that group of people is starting to have life events that's causing them to act on their long-term desire to purchase homes. So that'll help be a cushion in the economy, but I think it's very possible we have a mild recession sometime next year as a result of this long expansion and eventual capacity constraints.
Okay, thank you. I have no problem in agreeing with those scenarios you mentioned. So I add another opinion. I would just say that I think the world is growing at a very steadily pace. Last year, the good news was that the whole world seems to be participating, and that didn't happen for a long while. As Constance said, that could be a problem, but that's lesser a problem than the problem we had before when we had different velocities. I would say that I agree in the direction, but we are below our target. So we are speeding up a little bit, but we are not yet on our targets. Inflation is below what we think it should be, and it has been below 2% in the US, for example, since 2012. So a little bit of pickup is needed. So you have margin to cushion if you go a little bit more than what you were expecting. And I think that cushion is very valuable. I think, for example, taking Constance scenario, if you're thinking that you might have a recession in 2019 and you are the Fed, maybe you won't bother yourself to make 4 interest rate hikes. So what I think that you were in a very good pace until politics took part here. And I think being in your 9th year of expansion, you wouldn't like to mess with the economy. And I think the tax reform puts additional pressure and makes, for example, your scenario more possible in a moment that what you were willing to was for no one to make waves, because things at the pace before the tax cuts were okay. So I think the risk is that maybe you're pushing a little bit too much. And I don't want to be in the shoes of the Fed, where they have to take responsibility if they do 3 or 4, or my guess is maybe they do 2. Okay, so I think the economy is going well. Everything's going well. So the problem you have is the types of problems associated with things going well, which is uncomfortable, but I guess, I bet you that's better than the type of problems we have in Argentina, which is on the other extreme. And just to add another opinion, Mr. Trump dealing with tariffs, I think he has put on the table this problem of tax cuts, and now he reappears from the other extreme, putting another problem that works as a vector in the opposite direction. So maybe if he pushes too hard, and this is not chicken game, or it is, but there's some mistake playing it, maybe you do not get the expansion that the inertia is pointing to you, but you are going to freeze international trade, blah, 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 blah. And then, so you have to take care if things go bad and he's serious, maybe you have to, in a way, intervene in the sense of avoiding a freeze in trade and international economy. And I think the source for this agreement comes at this moment when you have to weigh what chances you assign to this southern trade issue, if how long or how far should it go?
That's exactly was one of the questions I wanted to put to the panel, is the tariffs, the proposed tariffs. What do you think the chances that they're going to happen? What do you think the ultimate outcome will be? It's a multifaceted question. So
let me take a crack at it first. I'm going to put on my Trump hat, and I'm going to say trade wars are good and easy to win. Okay. Why did he say that? What did he do? You know, I'm going to use the example of playing poker. You get dealt your cards. You have to make your opening bid. You look at your cards. You know what you can do, what you cannot do. But you also want to draw out the other players, want to figure out what they have. So you make an opening bid. In poker, if you want to scare everybody off, make a huge bet, and everybody leaves the table. Or you make a very small bet, but you have very good cards, and you have let the pot grow, sucker the other people in. So this thing he did on steel and aluminum was what I call the opening gambit in trying to get our trading partners, NAFTA, which is trying to renegotiate, back to the table, because it looks like the talks were breaking down. And these tariffs, if they apply properly, if he puts it on, that's another thing. He says, I'm promising to do it. That's been a week ago, and nothing has happened so far, as of now. So it's just an opening thing. They were backing away from the negotiations, Canadians and the Mexicans. They will come back to the table. And at the same time, Europe also displayed their cards, the EU, saying, we're going to put some tariffs on these things that you like, your bourbon, your this thing. They amount to $3 billion in total. So we've seen the other side, what they are willing to do. Chinese, being smart, have been absolutely quiet. They are the factory of the world. They buy all the raw materials from Argentina, from Brazil, from other places, make the products which are sold mainly in Europe and the US. So they said, well, it doesn't matter to me. I'm not selling them that much anymore of this steel and everything. And I don't want to rock the boat with my buyer. So they have displayed their hand saying, pass, blind. And then when EU said it, Trump came back and said, oh yeah, you know, We buy too many cars from you. We have a trade deficit on the cars. I can put a tariff on it. That has probably sent Germans running for cover. They produce all the cars in the world, and who buys them mostly? They buy them in Argentina too, but the Americans end up buying the most. And I'm a proud owner of a German car, adding to the trade
It
deficit.
was probably made in the United States, though.
No, mine is made in Germany. I made sure. So it's just a gambit, okay? Trade war would mean that we do the tariffs actual, they do another round of tariffs, we do another one, they do another one. That takes a long time. That can cause a recession in 2019, which is, as I said, another probability outcome, which I'm putting in not as high a number, but is there. So that was my 2 cents on the tariffs,
So the Chinese have since come out and said something. They have said that they're not pleased and that they're going to retaliate. But the interesting thing about these tariffs, and this gets a little bit down into the weeds, is a couple of things. One, these were done under what's called Section 301. 232. This is the Commerce Department doing an analysis and saying that under WTO rules, it is permissible to increase tariffs on goods that have an impact on national security. So that was an analysis done by the Commerce Department. You can opine whether you think it's biased or unbiased, but they did the analysis they were supposed to do, and this is the section under which they're announcing these tariffs. Navarro said yesterday, Peter Navarro, who's in the administration, said that Canada and Mexico would get a pass so long as they sign NAFTA. I agree with Rajeev there that that was a good negotiating tactic. But what Trump is really going for is the Section 301 tariffs. So Section 301 of the trade code, which would be if there is economic espionage. So that is the case of intellectual property being stolen. And this is the main charge against China, right? And this is what Trump is really going for, is Section 301. So this was just a shot on the bow, across the bow. There was a small tariff. They're probably going to walk back most of the tariffs on the non-Chinese. They may find a way to hit Vietnam, which is one of our top 10 steel and aluminum sources, and probably most of that steel and aluminum comes from China. The reason China appears to not sell so much steel and aluminum to the U.S. is because they channel that through other countries. And so that's what's going to go on with these tariffs. But if you play this chess game out several moves, what you're going to see is Section 301 tariffs, trade tariffs announced. And this is where it will get really interesting, because it's targeting the economic espionage that China engages in with most of the rest of the world, including the United States.
I'm wondering what your opinion as an Argentinian is. How does that affect your impression with, do we even want to trade with the U.S.? How does that affect?
Well, we do not.
I mean, I'm asking an opinion, I know. But.
Yes, just an opinion is not my area of expertise, if there's any. But I would say that we do not do a lot of trade. So we have to increase our trade, even in these conditions. So we start from a very low base. We have to increase trade. We are taking notice that this is not the 90s. This is a different world. We have withdrawn from the world for 12 years, coming back, thinking that there was a world of opportunities, and now learning that those opportunities could be a little bit less than thought because of these tariffs. If this is a chicken game or something like that, it won't hurt. But whatever, we have to increase our level of trade anyway, trading with the US or other people.
Mm-hmm. Any other thoughts on the tariffs, or shall we move? Okay. One question is, and actually our friend Richard came up with this one, was what are the causes of the recent rise in volatility in the financial markets? You know, like you said, it was a beautiful snowflake and everything was going along great. Now, was it a natural pullback, or do you feel that there's something more serious there? So is it related to how the Federal Reserve is generally not investing?
So the volatility, if I could take a first crack at this, that started in the equity markets. And there's a big technical reason why that volatility was so sharp and so severe. And that's because there was a trade that has become very popular over the last several years, which is writing puts on the volatility. And so hedge funds were doing this. There was an entire department at Goldman Sachs that 8 years ago was looking at the low volatility and said, well, this should be an asset class in its own right? And started actually selling this as a portfolio diversifier to pensions and others. And so what happened when equity markets started to fall, in order to cover these positions, there was extreme selling. And there was the index, but there are volatility indexes in Europe, in South Korea, in Japan, and some in Latin America, I believe. And so these products were most widely distributed in the United States, but they were also being used around the world. So the unwind of that trade and really sort of the opposite, it was a short squeeze, but on the downside, that's what you really saw exacerbate that volatility. Now, certainly we're getting to a point where the Fed is increasing the pace of their purchases likely this year. Maybe it'll be the same as last year. Maybe it'll be 3 hikes. But I don't think that the Fed looks out and says, well, there might be a recession next year, so we're going to go slower this year to prevent that recession. We're not certainly, I think at that point, and Dave could opine otherwise, but I don't think that's, it's like, don't call on me. I don't think that's where we are. So this increase in rates is really brought about it appears to be brought about by that tax policy, and also the market waking up to the fact that inflation appears to be gathering steam recently. So would I expect a little bit more volatility going forward than we've had over the last 5 years? Yes. That's much more normal. We've had spikes of volatility, but nothing really lasting. But if you look at this recent equity market volatility, a lot of that was around a technical factor in the market.
Absolutely. Anyone else?
I would say Constance has described the propagation mechanism very well. The people were there speculative, shorting the VIX index, actually going long on it, and trying to make money. And this trade worked very well for at least the last 3 years, for like easy money. And like every easy money, it goes away at some point. But the issue is, what was the precipitating factor? And that's where divergences happen. The talk about fear of inflation in the market that started with the US GDP report on that Friday, 26th, magnified the next Friday, the second, with the employment numbers coming out better than that thing. So that's one way. But I would go back another 5 days before that. On Sunday, before the January 26th, the US negotiations on the NAFTA went south that Sunday. And on Monday on the newspapers, it was reported that it's not going very well. There was a very weird statement where our trade representative comes out and makes a statement, but the other ones are not there. So I think that was another way to say the fear in the market that some kind of a trade disruption is now, the probability is much higher. And once you have that, if that's the precipitating factor and it gets magnified by the other things, then the propagation mechanism takes hold. So this is one story. I'm not a market player or something, but this is the way I see it. Trade is linked to quite a few things that are going to happen this year. And she asked about I would say, let's say China to hurt the US, puts some tariffs on soybean. Who are they going to come buy the soybean from? They can't live without the soybean. If their workers are working in the factory all the time, producing the goods, toys, and everything, they're not farming. Somebody has to feed them. That's the US and Brazil and Argentina. So if they put tariffs on the US, they will come more to Argentina. Your currency has become cheaper over the last 2 years by 25%, roughly speaking. You are ready to sell if you have it. Now I hear that you're going through a drought in this season, so the harvest may not be that good. So it all depends on whether you have enough soybean to sell.
Aren't soybeans priced in dollars?
No.
Which is excellent when you convert the...
Soybeans are priced in dollars, no?
Yeah. Okay, I would say that it's easier to explain why volatility picked up in January than to explain why it was so low for such time. And maybe it was because of this selling of short volatility. And the good news is that you have wiped out those positions in just 2 weeks and without having any serious credit aftershock, which is stunning. But that's what JP Morgan says, or the people that know says that there are no more overhang in short volatility positions. So that I think the final news is that the market is stronger than what one should have believed, paying attention to the build-up of this game for so long and very aggressively. I fear that under the new framework, we might have a problem with liquidity in the sense of a sudden disappearance of liquidity at the moment you need it most. We've seen those type of events with some bond tantrums, especially in Germany. I think it was 2 years ago, twice. In just one day, the German bonds yields multiplied by 3 or 4 in just one day. It was a very low number, but it was a very huge increase. Trading is the share of trading done by robots, algorithms, and things like that has increased a lot. There are new rules that prevent people from carrying the risks in their own books from one day to the other, etc. So if you get a fear, I think you run the risk that robots and algorithms disconnect, people disconnect, and you may find even a sovereign bond market like the German bonds or the treasuries without any liquidity at the precise time when you need to sell. And that was a risk at this moment that didn't appear, even though it was something like a flash crash in the stock market in the last half hour of a Monday, I think it was. So I think the problem with volatility is not what we have seen, but what we might see if things go extreme and the calm doesn't return very rapidly. And we might find that we have huge positioning in assets that we pay thinking they have at least the liquidity to leave the positions, and find that that's not more possible.
Do you
If I
think?
could just add,
Please.
So, Rajeev brought up a good point, was that the NAFTA negotiations turning more markedly south was sort of a trigger to say, hey, maybe these equities are a little overvalued. What you've seen in the last several days, anytime there's been bad news about the new tariffs that Trump has proposed, the market sold off. And so as soon as Europe said they were going to retaliate, you had the market sell off. So there is some market discipline that's coming into play. It's a feedback loop that I think could have important implications for the outcome.
I wanted to follow up a little bit on what you just were alluding to slightly. Do you feel that there's any chance of an emerging market sovereign debt crisis occurring?
Oh, we live with that fear every morning. We read the papers and then follow the conclusion it won't be today. Okay, but there are papers every day. I would say that this was a very huge test, and the response from emerging markets was superb. Spreads, if you compare emerging market debt to the US Treasuries, spreads didn't move or they shrink, and the same happened with high yield, etc. The only exception was our debt, unfortunately, this time. And I think that we are receiving a signal that maybe we have to address more strongly some of the particular issues of concerning our economic policies. But there has been a very good response from emerging markets in general to this squeeze, which was the second biggest since the Bernanke's bond tantrum. And if you compare 2013, what happened there and what happened now, the asset class performed superbly.
Would any of you like to comment on kind of the speed to recovery that we see now? Yes, we have these this volatility, but it seems like it lasts such a short period of time. In times past, we would have a correction. We didn't even actually get to a correction in the U.S. market. We got tickled it, so to speak. But when we're back right away, I remember having conversations with clients in February who thought the market was down 8% year to date, and in fact, it was flat. So do you want to comment on the kind of crisis to recovery and the speed and how that is changing global markets?
I don't know that we can say that it is necessarily changing, just because we had a pullback and then and again, this was very technical in nature.
Mm-hmm.
So this was triggered by fundamentals. It was as Rajeev laid out, but its magnitude was triggered by technicals, right? And a technical feature of the market where there was a specific pocket of over leverage in equities. But I don't think that means that what we can do is forecast into the future and say all downturns are going to be met with buying the dip and quick recoveries. I think that as we go, we're in the end probably of the global recovery, certainly the US part of that recovery, as we get closer to the optimal Fed policy for this environment. And as this recovery becomes longer in the tooth, I can't with any certainty, it would be malpractice to come up here and say that volatility experience that we just had is going to map the future volatility experience.
I just want to add something on the volatility issue, because in the last 4 or 5 years, we've seen the temper tantrum, some other things. Why does it happen? So I read literature. There's a paper by John Giannakopoulos, if I can pronounce his last name right, from Yale University. And summary of the paper is this. When an investor, a dominant investor in a pack of investors, changes his or her beliefs, and other people follow, you will have a cascading effect in the prices of the assets. And that's what happened when Bernanke had retired and he was doing the lecture circuit, getting paid $250,000 to give a speech. And he had been going around saying the Fed will be very, very deliberate in raising the rates. And one of the hedge fund managers said, yeah, he gave that speech to us a year ago, and I didn't believe him, and I didn't make the money. Because when the beliefs change and the leading trader goes, let's call it, in the old days in the bond arena, when Bill Gross of PIMCO was the bond king, now it's Jeffrey Gundlach, when he would say something, traders would follow. I mean, I have interacted with some of the traders. Let me just tell you one thing. We academics and other people love to talk about inflation and inflation expectations. Talk to a trader. If they can spell inflation, I'll give them a plot. All they say is like, we watch the TV, it's Bill Gross, at that time it was Bill Gross. Bill Gross is talking on the TV. We know he's talking his book. Either we follow him or we go against him. That's what it is. And they follow the herd, most of them. But when diverges, the entire herd will go that way. So that's going to now to be a facet of the economies, whether in any asset class. The issue is that 1,000-point fall in 1 hour, to me, was markets working. You didn't hear about people saying, I couldn't find a counterparty to trade. Mm-hmm. Everybody cleared out. At the end of the day, okay, loss is done, everything done, but positions were net. Mm-hmm. To me, the problem would be if the 1,000-point fell and they had to stop the stock exchange for 15 minutes to have a count.
Correct.
So
correct. It's an orderly market.
Right.
Absolutely. It sounds to me like we might need to have a session on behavioral economics sometime in the future. I think that would be fun. According to my phone, we have like 3 or 4 minutes for questions. So I'm sure you all have some.
So I have a question for Constance, born out of pure ignorance. So on the chessboard trade moves you described, if the intent is to get to the intellectual property kind of elements of it, why all the steps in between? What's the deal?
Let me just get out my Trump mind crystal ball. It's a little cloudy. That's an excellent question. And I mean, look, this could be a miscalculus, but in my conversations with administration officials, people who've formerly been involved in the USTR's office, that was sort of the consensus, was this is sort of where we're going with this. But you're right, why start with this broad thing? And I think that feeds into Rajeev's theory that this was Trump sort of saying, well, let me just play my cards. It was also something that's really doable. It's easier to do the 232 than it is the 301. 301 requires a lot more research and in-depth analysis. The administration is understaffed in many different departments in many different areas. So it's possible that Commerce was the one that had the capacity to start this. So it had sort of the twofold benefit of being doable and being something that would maybe have positive externalities around NAFTA negotiations or other trade things that Trump wants to get done. And then furthermore, the optics, if you're not steeped in international trade relations, I had Jagdish Bhagwati as my thesis advisor, who talks about multilateral trade deals versus unilateral trade deals. And so most people don't know anything about that, right? So if you're the average voter in the US, what you see is my president is being tough on trade, right? So I think that the fact that it was doable, the fact that it had optics at home, the fact that it sort of put other countries on notice, even if it was going to be walked back, made it an attractive first choice. But that's just my speculation. Could be entirely wrong about that.
I mean, on the optics, he filed his renomination papers the day before, appointed a new chairman for his campaign for 2020, and next day he said, let's have some tariffs. So the base is, you're doing something for us.
And by the way, as I understand it, nobody was prepared for this. Like, it wasn't like he told Commerce, hey guys, today's the day I'm going to pull the trigger on this analysis that you've been doing. It's not like he told anybody on the Hill that this was coming. As far as I know, the CEA's office didn't know about it. Treasury didn't know about it. Cohen certainly didn't know about it. He resigned. So I may be ascribing too much strategy to the situation, maybe projecting some onto that situation, but
it's not the only case of war games during this administration. Take that little guy from North Korea. You start in sending tomahawks to Syria one day, the other day sending the mother of all bombs to Afghanistan, and then tackling with him. That was in just 3-4 days. And you push that, and now you're playing another war game, and nothing happened in this field. Exception made by the Olympics, where Southern and Northern Koreans were singing all together. So if there's a political, if this is a political game, this is the second time they are trying these type of things.
I have one question. Given the fact that we have a growth cycle that is very long in the US, and we have a tax cut in the middle that could push inflation pressures, do you imagine that the Fed, as playing the counterbalance of the inflation, will have enough space with the president that is actually at the White House?
Yes, the Fed prides itself on its independence. And the fact that I can answer that question so shortly, and I think probably most of the Americans in the room would answer similarly, sort of underscores that.
Well, that conviction is something very important, as following what he said, that beliefs are very important. Because we have a new chairman, we knew the other ones, this is a new guy, and if you take a look at all the governments, the governors, there are at least 4 empty seats that will have to be filled by Mr. Trump, even though the Congress should approve that. So I think that's a very strong belief. And if we anyway have less belief on that in the following times, we might have a problem there.
I would like to know your opinion about what are going to be the next decisions of the U.S. In reference to Venezuela situation, economical situation, and the debt, the sovereign debt, and the PDVSA debt, and how do you see the future?
Let me answer this question slightly differently. I am very worried about Venezuela. And do you think it's the suffering of the people that's motivating me to worry about it? No. I only care about one thing. I live in Atlanta, okay? I have one pipeline that brings in the gasoline from the Gulf refineries, okay? When that pipeline breaks down or the gas doesn't come in, we have problems in Atlanta. We have no alternatives of getting gas any other way. New York people can get it by ship from other pipelines. Our Gulf refineries are built upon doing refining of the thing called the sour crude. And most of the sour crude comes from Venezuela. That's what I care about. Venezuelan oil production is now down by 1 million barrels per day compared to 2.6 a year ago, compared to 4 million 5 years ago. Okay? And we have made up some of that deficit by using some other oil. But if Venezuela implodes and that 1.6 million goes to zero, it may cause no trouble in California, which refines the Alaskan crude and the other one, nothing in other places, but I will be in trouble in Atlanta, and I have a gas hog of a BMW. Okay? So I worry about Venezuela every day.
I think this will be our last question.
Hello. Having in mind that the consensus is that there might be a recession in the next 1 or 2 years, how do you think Europe is prepared for that, knowing that it's earlier in the cycle and also it's early in the cycle of normalizing monetary policy? How can it deal with the US recession?
I just want to say we didn't have a consensus about a recession next year.
The market consensus, at least.
Even the market doesn't have the consensus, but you can phrase it that if there was a consensus of a recession next year, okay, how does Europe react? Now I'll leave that to my panelists.
If there were.
Well, so I guess, and I'll rephrase it if you don't mind. I'll rephrase your question even further and say, if a recession were to materialize in 2019, how would Europe deal with it? I think that they have policy. Well, they're running out of bonds to purchase. They're obviously. Everybody expects that they're going to announce the tapering. I didn't listen to the press conference this morning. Was there anything groundbreaking that one needs to know from the ECB press conference this morning? Tracy?
The GIC meeting is more important. Yeah.
Anyway, so with the proviso that nothing new was said or nuanced, they're doing a pretty good job of jawboning and saying that they're planning to taper. And so they might reaccelerate bond purchases. It's possible. By 2019. And it also really depends on what happens within the European economies, right? There are a lot of Europe-specific situations that are occurring. What kind of Italian government do we get? How is Brexit going? Will Macron's labor market reforms revive France or cripple France? So I think from now until 2019, there are many more Europe-specific questions that need to be answered. And that's probably foremost on the mind of the ECB. And furthermore, it's hard to get my model to do a recession, right? Now that probably speaks as much to the model as to anything else. But I need to get a surge in wages with some lag, some inflation, and then a recession. But it's a mild recession.
The slope of the yield curve, it's a best predictor 1 year ahead. And the current slope signals between 10 and 15% chance of a recession in 1 year. So it's on the agenda, as she said, but it's not a fact.
And in Europe, the dominant thing is Germany, and with the ECB presidency changing next year, the front runner seems to be Jens Wittmann, the Bundesbank president. You know how he's preparing? He climbs 11 floor of stairs to his office. He's going to increase that to get to that 43rd floor of the ECB. So that was one of the points in the Financial Times, article, Lunch with Him. They do this series. So the issue would be there's not going to be much changes between now till the next president comes in. And is Europe ready for a kind of like a hard-nosed German banker, to be the head of a coalition that has to govern all different kinds of European countries. So they're already talking about, different candidates, maybe the Bank of Finland governor, maybe Dutch one, who are supposed to be more pragmatic, but more acceptable to the Northern Europe as possible candidates.
Thank you so much. I know that, I'm sorry. I'm to turn it over to Michael.
Okay. I just want to thank you all for coming today. Thank all of our speakers. So my boss, Joe Fernito, tells me that the GIC group is supposed to stay here so that we can all move to the next place together. I would like to again thank Ramiro for your wonderful assistance in putting this together, to the university for this beautiful room and the sponsorship and speakers. And we look forward to seeing you next year.
Nice talking to you.